Hi, it's Lee and welcome to the Tesla Economist. As many of you know, I've been struggling with Tesla since Elon mentioned Tesla could even run at a loss this year if we go into a bad recession. He even talked about how it was a better idea to be investing in companies that make bread, for example, or that one of his friends was even shorting the S&P. Prior to this, we've always seen Teslas having great demand, hence why we have been investing in the stock. And a lot of the numbers I run have the company making a profit, even at much lower margins than today. It was a highly profitable company, and even in a recession, these prices seem amazing value, especially factoring in not only no fuel costs, but also potentially a $7,500 tax credit. Tesla looked like the company to invest, but we're now seeing potentially demand drying up. And looking at these latest delivery numbers, to me, it provides further validation. Yes, if you're looking for confirmation bias right now, you can tell yourself that 30,000 of them are actually in transit. But transit to where? Not only have the waiting list dropped to this month, the inventory is also building up now. And it's mainly because of what Elon said. People don't want to buy assets with debt, like cars or houses, because the opportunity cost of the money becomes so much higher when interest rates rise. Even the lower priced Model Y rear-wheel drive seems to be having demand issues, despite it being a relatively low price. However, the export market is mainly Europe, and Europe is also ramping up with local production as well. Although they're ramping a different variant of the Model Y, a long range and performance. The strange thing is that the rear-wheel drive in Germany only costs €3,000 less than the long range, which you could infer to mean that they're trying to sell the locally made ones more. They save in transport costs and tariffs, of course. I know we likely all love Teslas. They are amazing. I can't believe it. It's like the smartphone of cars. And Elon must have had the best engineers in the world making it what it is. An electric car with a full interactive screen. And they worked hard on it. But perhaps not everyone sees them like we do. Perhaps it's not as important to everyone as it is to us. We can believe that they'll be the best-selling car in the world, but perhaps not everyone else cares about those features as much as us, or thinks they are that revolutionary. We have to follow the data. But we saw so many nations that had the best-selling vehicle of the month being a Model Y. But this is possibly because Tesla batch shipping to various markets at inconsistent times and absorbing the backlog. But it makes great headlines for Tesla. People loved these cars so much they just thought everyone should have one. Even people who couldn't afford a car, they could use a robotaxi instead. Everyone would be able to afford a robotaxi. Because Tesla was on a path to solve FSD, and wow, after the first AI day, it blew my mind just how complex and a challenging task FSD really is. Humans are just amazing at some things. But even if Tesla solved FSD and it passed regulation, then would everyone even want to use it or want robotaxis? As you know, I never baked FSD into any of my pricing models, but I did bake 4680s and growth. 4680s meant increased production and lower costs. Also, the improved driving experience. However, so far, all we've seen in regards to the 4680s are still that it uses the same chemistry as 2170s, which means using cobalt. They're not as energy dense as the 2170. The weight difference of the structural battery pack is not much of an improvement, around 20 pounds. But the other day, when Tesla reported on a 4 gigawatt hour a year run rate, we were told 100 gigawatt hours on battery day, and then it kept changing to things like high volume production towards the end of last year. But 4 gigawatt hours is not what I call high volume production. It's not really much at all. And it appears to be mainly coming from Cato Road, which has been operational for over 2.5 years now, formerly called Project Roadrunner. But this can be inferred that they are at a 40% run rate of the 10 gigawatt hour capacity at Cato Road. And there is a 100 gigawatt hour capacity in Texas. And if they get to 40% there, that's enough sales for volume production of just about the Cybertruck and the Model Y. But we only have 4 gigawatt hour a year run rate, or as Tesla say, 1,000 cars a week, which was actually the target they did announce on the Q3 earnings call. So they did hit that. However, the target on the previous earnings call in the past have been 100 gigawatt hour a year run rate, 25 times more. Now, this is what is required for the new factories. They need 4680 cells. That's what they were designed for. Currently, they're using 2170 cells, but these are limited according to Elon. Tesla may have got the likes of LG or Panasonic to ramp up production a little, but only so much. Look at the size of Giga Nevada, and it only has a capacity of 35 to 40 gigawatt hours a year, or enough for 500,000 long-range Teslas, and nothing left over for the semi-truck, which is very hungry on 2170 cells. The new factories are bringing down margins heavily. They're very expensive to run. Tesla need to get economies of scale in those factories to start getting decent margins. They appear to be struggling and only reaching 3,000 vehicles a week after about a year of production, compared to about 5,000 a week in Shanghai after just half a year. We were expecting these facilities to be even more efficient. Also, Tesla are currently selling their Model Y from Texas at $66,000. This price will not be sustainable. It will also need to get under the tax credit, so the price will drop to perhaps $50,000 or thereabouts, as the tax limit is $55,000, and leave some room on price for options like paint or wheels, so it qualifies. The last time the Model Y was at that price was mid last year, but there was only 4 to 6 weeks waiting list, and perhaps selling around 200,000 in the US. With the tax credit, this price would become $42,500, which feels like unbelievable value to us. But if in a normal market they had a 4 to 6 weeks waiting list, in a recession, it might be different. Although the price is lower, whilst also trying to sell potentially closer to 500,000 Model Ys in the US though. So trying to sell perhaps 2.5 times as many Model Ys in a recession, but at a $7,500 lower price point too. However, there is competition with even lower priced PHEVs, plug-in hybrids, with $7,500 off too. And as their cars are cheaper to start with, the tax credit is about 30% off the price of the car, compared to only 10 to 15% off at Tesla. And what about the battery and cell factories that Ford and GM are building that come to around 100 gigawatt hours a year or so run rate? What if they are actually going to be for plug-in hybrids rather than full battery vehicles? It's as if they can make 1 million BEVs a year or 5 million hybrids a year if the scarcity is batteries. Obviously, 5 million hybrids each getting $7,500 off would be hard to compete with for BEVs, whilst also serving the same purpose, minimal running cost. Anyway, Tesla have to get costs down by ramping up 4680 cells to get some sort of margin. However, they have to get costs down by increasing supply, because the more these new factories ramp, the cost of goods sold per vehicle does reduce. So Tesla have to get production numbers up for Berlin and Texas. But it sounds like they are limited by cells, or will be sometime this year, as they deplete the 2170 stockpile, which we don't know when will occur. But if this is a possibility, then this could reduce production considerably, maybe to 1,500 units a week. And bear in mind, they're not going to be able to sell them at $66,000 like they could before. Tesla's gross profit per vehicle from that factory will probably halve. If these factories start losing money and the prices are cut across the board, then this is the biggest way I see that Tesla could actually lose money this year, from what Elon was saying. But perhaps that's because I think of $35,000 for a Tesla as good value. But things may be different in a recession, and people may not even be willing to spend that much. Anyway, therefore, I see that there is the potential that Tesla may not have enough cells to keep Berlin and Texas profitable, especially if they have to drop the price and lose lots of margin. And then even if they could ramp these factories up, we're talking about a global capacity of around 1.5 to 2 million Model Ys a year, about the same amount of Toyota Corollas that sell in a regular year. Yet they'll still end up costing twice as much at least. And in a recession, at a guess, I think Tesla would cut back production in Shanghai to around where it was before the last line upgrade, perhaps 50 to 60,000 a month. And these might become quite low cost, except they can't be too low a cost in Europe, because they are competing with the Berlin Model Y. So it's more for China, Australia and Norway, hence why Teslas have been selling well in Norway. They offer incentives and have no local car industry. So this is the risk I see for Tesla in a recession. 1.5 million of one model is a lot to try and sell each year. In a recession at those price points, I don't think it's possible, but that would still be if they can ramp. They may use LFP cells in Texas if they cut down production in Shanghai, and perhaps they might use blade batteries in Berlin, and there'd be enough available perhaps. But then they'd lose even more profit per car sold from Texas, and I don't think the largest factory in the world is that cheap to run. Therefore, if you drop prices as much as we're suggesting and have to cut down production a bit, then it won't take much for these new factories to return to a negative gross margin. And as the other factories are decreasing prices and also reducing profit, this loss becomes relatively higher. A lot of investors are hoping energy will do well next year. The numbers are that potentially if the Megapack factory does hit its capacity, we could see around $10 billion in gross profit this year. Yes, these are the numbers. But for me, that is a lot of ifs at this stage, including if they get these margins that people are saying around 50%. Tesla not making significant profits this year will make the PE ratio increase a lot higher relative to the current stock price. Even if Tesla produced $5 billion this year in earnings, then it still puts it at a forward PE ratio of 75 or so. If that's Tesla's profits and they're not showing growth, or even the opposite, then that will slaughter the PE ratio. And how many times can Elon say FSD next year or this year? And when everything else is having issues, investors stop believing in the FSD possibility. But without 4680, then Tesla's future growth cannot grow to the exponential we hoped. It's at the mercy of 4680 scaling. Yes, Tesla could likely get more LFP cells from China, but it would appear they have already saturated their demand for rear-wheel drive models. And yes, perhaps Tesla could release a new low-cost model that does use LFP cells, but they'd also need a new factory to build such a vehicle. So Tesla could end up being valued as a car company with no growth and minimal profit. I agree there is still all the AI value within the company and other areas of value, but you don't know how it will be valued in a recession. These are the issues I see for 2023, especially if in a recession. Let me know what you think in the comments. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.